My name's Carson and I'm the Chief Investment Officer at Quick Brown Fox Asset Management and a Portfolio Manager for the TAMIM Australian Equity All Cap Value IMA. Big day on the markets today with plenty of results coming out. The biggest one of all was the biggest company in the index, Commonwealth Bank, and the result here beat expectations. Cash profit was up 2%. Interestingly though, that cash profit was up 2% whilst assets actually rose 8%. The drag on earnings came from a decline in the net interest margins on increased funding pressures. Now, half an hour after the result was announced, the bank moved some of its interest-only investor mortgage rates up in order to boost that NIM over coming periods. So it'll be interesting to see what impact that has over the next 6 months. One of the other drivers of the profit was that loan impairment expense fell over the last 6 months relative to the last financial year. That was on the back of lower corporate defaults in the last 6 months. But interestingly, one aspect of credit quality has deteriorated, and that's what's happening in Western Australia. Western Australian mortgage stress is rising, and that actually led to the Bank West division reporting a fall of profit of around 1%. Moving on to Wesfarmers, and we saw some strong growth in earnings here with net profit up around 13%. The company also increased dividends around 13%. One of the key drivers was the spike in coal prices over the last 6 months, which boosted profit. The spike in coal prices offset some weakness in coals, which is seeing increased competition from the likes of Aldi and Costco, as well as a re-energised Woolworths. With the coal price coming back to earth after a big spike last year, the drivers of growth going forward aren't quite as clear as what they were a few months ago. So moving forward, there could be a little bit of pressure on Wesfarmers' earnings. CSL was also out today, one of the highest quality names in the Australian share market, and it was a typical high quality result from CSL with a big rise in profit and earnings per share. The company also maintained their guidance, which was given in January, of 18 to 20% profit growth for the financial year, and a corresponding rise in EPS, which will actually be greater than the profit growth given buybacks. The standout today though was Computershare, which reported a strong rise in earnings per share. In fact, the earnings per share numbers for the last 6 months was the highest 6 months since 2010. This was driven by acquisitions in the mortgage servicing space, both in the US and the UK, and that offset a decline in registry services revenue. Looking at the smaller end of town, and one result that caught our eye was A2 Milk. They reported a very strong rise in net profit. The company has been picking up a lot of market share, particularly off competitors like Bellamy's, who have had a difficult time in recent periods. A few major disappointments also came out today. Domino's was one of them, and the share price is down around 8%. This was despite strong growth in earnings, and there were a couple of offsetting factors. One was a slight miss in the revenue number, and the second one is a recent press coverage questioning payment of their staff through their franchise network. Another disappointment was primary healthcare, where net profit fell 15% and net debt rose. Contrast this with another result out today, Sonic Healthcare, where we saw profit up 5%, boosted by offshore earnings, and it's clear that one of these businesses is doing well, whilst the other is not. Primary shareholders will be hoping that the recent takeover rumours come true.